The next module we want to talk about is dealing with land use controls and regulations. So, I guess the main subject matter we'll be dealing with here is, if you do own land or you own real estate, could anybody else have any control over your real estate? And I think you'll find the answer is absolutely. And so we're going to take a look at what some of these land use controls and regulations could be. And you see some of the topics, specific topics we're going to be talking about. Obviously, the government will certainly have rights in land. And then we're going to look at some public controls, which basically, again, dealing with the government. The government does have a lot of control over private property through something we call police power. We'll be going over that. Environmental hazards and the regulations that go along with those, because if there are any environmental hazards that you're aware of, dealing with the property you're buying or selling or assisting someone to buy and sell, obviously all that has to be disclosed. But then there's also some private controls, regulations, things that we put on ourselves. Does not necessarily the government. But those are some of the key topics we're going to be going over. But we're going to start with what are the government's rights in land. And obviously the biggie is taxes. Can the government require you to pay taxes on real estate? Absolutely. And what's very interesting there is not only do you have to pay the taxes, you got to pay them every year. How about that? So, we need to talk about these taxes, property taxes, and how does the government determine what the amount of taxes will be? You're going to need to know how to do that for test purposes. You will have to calculate taxes. So let's talk about some of that. First of all, you see a term called ad valorem. That is a term you could likely and will likely see again. But ad valorem just means at value. And the point here is, if the government's going to tax real estate, then the law says that the tax must be based on ad valorem. It must be an ad valorem tax, meaning based on the value of your property. So obviously everybody does not pay the same amount of taxes. If you've got a $500,000 home, you're going to pay more taxes than somebody that owns a $200,000 home. Again, because the tax is based on the value of the home. Now, so where do these taxes come from? Well, they typically are generated at your local level. Whatever municipality you may live in. And there is a formula here, and you should see it in your text as well. And I got to tell you, you need to memorize these formulas, okay? This will help you substantially. But it says your taxes go like this: market value, the value of your home, times the assessment ratio, times the tax rate. That would end up giving you what your amount of taxes would be. Now we're going to go through these things and explain it a little bit, hopefully where you can understand it. But that's part of the formula. So let's just sort of start at the beginning. It says the tax rate is also referred to and sometimes called millage. So whatever your millage would be, that's considered your tax rate. And the millage will vary from district to district or one municipality from another municipality. And for different reasons, okay? And we're going to take a look at that. You see also on here what's some examples of some of the taxing authorities. Water. Somebody's got to pay for the water. The fire districts, fire departments. We got to have money to pay, to pay and buy the fire trucks and firehouses and stuff like that. We got to pay for our schools, library. There's several things. These are just a few examples. but this is why you're paying taxes, because all of this stuff has to be paid for. Okay. Now, before we actually get too deep into the actual property tax, some other things you need to kind of go along with the property tax are what we call general and special assessments. Now, these are very interesting, and quite frankly, if you understand some of this stuff, y'all could be a little irritated. I know it is for me. When I see some of these assessments that they charge, it's a little bit irritating in some cases, but what they're talking about is this. They a lot of times, the government is supposed to establish a budget, so they know how much money they need to operate, right? So then based on that budget, then they should tax property owners however much they need to generate enough income to pay for things that have been identified in the budget. Problem is, it seems like the government has a hard time creating a budget. So I'm not sure how they get away with it, but hey, that's the government for you. But could things pop up throughout the year that were not part of the budget? Okay, obviously creates an expense, but it was not in the budget, so there's not any money to pay for it. Those things happen. And what they'll do is, they still got to pay for it. They got to repair things. Something breaks, they got to repair it. And if it wasn't in the budget, then they will issue what they call a general or special assessment, which will be your prorated share of what you owe in taxes to help pay for this unexpected expense. An example they use here, maybe the municipality decides to put a sidewalk down the road, okay, on the side of the road, which is probably not a bad idea if you got a lot of walkers and stuff like that. But anyway, who's going to pay for that sidewalk? Well, the municipality will determine those that experience what they would call a betterment would have to pay their fair share of that sidewalk. So they'll figure out how much it would cost per foot of sidewalk. And then based on how many feet of sidewalk actually borders your property, if you happen to live on the street where they're putting the sidewalk, then you're going to be considered receiving a betterment by it. Then they'll just take whatever the price per foot of the sidewalk is times however many feet you own that borders that sidewalk, and that's what your prorated share or assessment will be. And this will be tacked on to your property tax. Okay, so it just kind of keeps going up from there, it seems like. But that's what these general and special assessments do. Now let's get into how your actual property taxes are calculated. And I'm just really throwing up some examples here. But what the municipality will do, first of all, they'll have to determine what's the total value of real estate in that district. Okay? In this example, they're saying we have $100 million in property value throughout the district. We know, in this example, we're going to have to create $1 million in order to pay for things that have to be paid for in the budget. So based on that, we got to figure out what the millage is going to be to assess each property owner. And to do that, they just take the revenue, which they know we have to have $1 million, divided by the value of all the property in the district, in this case was $100 million, and that would give you 1%. Okay, so your millage would be 1% of whatever your property value is. All right, so that's the first part. Got to figure out the millage, and basically that's your tax rate, 1%. Again, in this example. What it would be and where you actually live, it will vary. It will be different. Okay, and then this is just the example. But then we got to take it a step further. because we also have other needs and things that have to be paid for. Again, in this example, like the city will have to have some money to pay for the stuff they need to pay for. Schools have to be paid for. Y'all, and there could be a whole laundry list. In fact, there will be a whole laundry list of things. Here, I just threw out a couple things there just to give you an idea of what we're doing. But again, in this example, for city millage, city mills, y'all, they're saying the city's going to need 0.5%. And again, we're talking about percentage of whatever your property value is. So if the real estate you own is worth $200,000, then they would take the 200,000 times the 0.5%, and that would be what they need from you to operate the city. But then for the schools, y'all, public schools, y'all, in this example, they're saying they need 3% of your property value to pay for that, right? So if we add all these mills together, remember we got 1% that we were talking about for the county in the previous slide, plus the 0.5% for city mills, plus 3% for the schools. Now we're up to 4.5% that will be charged to create enough tax revenue to pay all the bills, right? So we're looking at 45 mills. If you take the 4.5% times 10, that gives you 45 mills. Now I will tell you, it's going to likely be a whole lot more than that, because we only used a couple things here as an example. Just again, it could be a whole laundry list of things that's got to be paid for. So in this example, we know there's going to be 45 mills that will be assessed against you to create enough revenue to pay. Now, let's look at an example how this would work. So in this example, we're saying your property is worth $500,000, $500,000. Your assessment rate is 8%. And now, y'all, look, the assessment rate is something that is usually mandated by states. Okay, each state will have a different assessment rate, most likely. So 8% may not be the rate that would be charged in the state you live in. So this would be something you would need to know based on your state. And when we do get through with the national portion that we're going through now, then we'll also be going through your state-specific portion of the course. And then we'll actually go through exactly what that rate would be for your state. Okay, so y'all, again, so this 8% is just an example. That's the assessment rate. But here's you also see the formula to help you calculate these taxes. But it says your assessed value will be your property value times the assessment rate. What I want you to be careful of here, y'all, there's a difference between market value or appraised value, sometimes you hear it called. And in this case, it would be $500,000. So your market value is $500,000. That is not the same as your assessed value. Y'all, the assessed value is what they use for tax purposes. So how do we determine what the assessed value would be? Well, they take your property value, which here again is $500,000, times this assessment rate, again in this example is 8%, and that would give you $40,000. Now again, so $40,000 is your assessed value. Again, y'all don't get these confused. So again, market value in this example is $500,000. Your assessed value for tax purposes is $40,000. Now, once you know your assessed value, you take that number, multiply it by the millage that we just went over, and that will tell you how much property taxes you owe. So again, in this example, the assessed value is $40,000 times 45 mills. Now, what you're looking at here, and again, this is something you need to remember, so write this down if you need to. We know there's 45 mills, again, in this example. When you start calculating the taxes, you're going to have to convert the mills to a millage rate. Y'all, all you have to do, and by the way, mills or millage means thousands, right? So, however many mills you have, y'all, there must be 3 digits to the right of the decimal. Okay? So in this case, there's 45 mills, so I got to add a 0 because there's got to be 3 digits. So you put the decimal 045. Now, if your millage was 200 mills, then the millage rate would just be 0.200, right? If your millage was 1,200 mills, then your millage rate would be 1.200. So again, there has to be 3 digits to the right of your decimal to create your millage rate. Okay, just move your decimal 3 places, and then that will be your millage rate. So here, 40,000 times 0.045 would be $1,800, which is what you would owe in property taxes at the end of the year. Okay, y'all. So that hopefully gives you a reasonable idea of how these property taxes are calculated. And again, when we get into what the state-specific portion of this curriculum, we'll actually be going over exactly what your state numbers are, like the assessment rate, tax rates, and all that stuff. It'll be more specific to your state. This is just to give you an idea. But again, you also see the formulas there at the bottom of this slide. It's also in your text. But if you can remember these formulas, because if you know any 2 of those 3 components, shouldn't you be able to figure out the third? And that's the idea. Okay, so if you get a tax question, and you will, if you know the formula, just take the information they provide to you, fill in the formula with that information, and then you should find you got enough there that you should be able to calculate whatever question they're asking you. Okay? Now also, last point, in this example, so your taxes, property tax, are $1,800. But again, if the county had any unexpected expenses, like they built that sidewalk, and say you're going to have your pro rata share of that sidewalk is say $200, then you'll see you owe $1,800 in property taxes, and then it'll also show you owe an additional $200 in special assessments, or maybe a general assessment. So in that case, your total taxes due would be $2,000, right? So, hopefully that wasn't too confusing. And, there's some example in your text. We got several examples, questions that you can go over. And, I think you'll find it's not as difficult as it seems for sure. Okay, so that's your property taxes.